was reading through the articles this week, and one of the things I think, and obviously it's a focus of this show. Prior to us, David Graham's talking about guaranteeing your retirement. We've got a lot of retirees or soon-to-be retirees that listen to the show, and we've talked in the past about how we're gonna gear some content towards buying investment properties, second homes, vacation properties, things like that in your 401k and IRA. But I saw an article this week, 55 plus housing market, one of the healthiest segments. And the National Association of Home Builders came out with this study, and more or less it's just, I think, more ammunition that our new construction market is going to continue to do well in Florida and in Tampa Bay, because the new builders are realizing that is a segment to build new construction for. Build 55 plus communities. You've got some great local 55 plus communities that are newer. You have some out in Sun City Center. You've got Valencia Lakes, and I think what ends up happening is when a new segment or a new piece of the market, so to speak, is uncovered, builders are going to go to it and build a lot of it, and I think there's going to be a lot of attraction. The concern is 3 to 5 years down the line, do builders build too much inventory for the 55 plus market, and then they decide, we don't really like these master plan 55 plus communities, we want to live with everyone else, and that's the only caveat I have, but it's certainly one of the healthiest segments. And one of the things I want to ask you, Arnie, let's say someone's retired, they're on a fixed income, they have the cash to buy, but they'd like to get a mortgage. What are the things someone who's looking to buy a 55 plus home, or is on a different type of income where it's not necessarily employment income, what are the things that are different they have to do to qualify for a mortgage than someone who is regularly employed?
Well, there's a couple things that come off the top of my head right away, Andrew. One of them is a term called asset dissipation. So basically what we do is we look at your assets and we make a calculation based over maybe a 15-year period, because you're probably not going to have your mortgage much longer than 15 years or maybe
right.
30 years, and figure out what that monthly income would be if you were just pulling it off your assets every month, and we would qualify you based off of that. So we actually, even though you don't have a job, or
you can use the assets as their income.
I can use their assets as their income, basically as a income stream, if you will.
And speaking of that, so somebody that's in that type of scenario, any difference in credit qualifications or rates, or are they comparable to other programs in the marketplace for someone that's out there in that situation where they don't have a job, so to speak, but they have assets and they want to use those assets to qualify?
Well, that program is comparable as far as rates are concerned. There is another program out there. You have to be over 62 years of age, which is called a reverse mortgage. And you can actually use a reverse mortgage. So what's a reverse mortgage, right? Reverse mortgage is a mortgage. You have to be 62 years of age. You obviously not going to get the loan at 95% financing.
Right, you're going to get a lower percentage of loan to value.
Lower percentage loan to value, and the older you are, the higher percentage. Okay, and basically it's a great loan. It's people don't talk about it that much. People don't understand it that well, but technically you get the loan. You don't have to qualify for credit-wise.
It's all about the equity in the property.
It's all about the equity in the property, and guess what? You don't make a payment for the rest of your life.
But you get to draw income.
You draw income. I mean, you can structure it a bunch of different ways where you can draw income, or basically you're preserving your income, so you can live off that. So here my personal mother. Everybody has a personal mother.
Your business mother.
My business mother, my personal mother. And somebody who called me mother. No, just kidding. So anyway, we've actually done it twice on her house, and my aunt as well. So my personal.
Your personal aunt. My personal mother might look at it. What about your personal mother? Your personal mother.
My personal mother is probably going to be guided by my personal father.
Right.
Okay. It's interesting. One of the biggest questions I get on reverse mortgages. I have people that come to me with those questions all the time. When it's one of the few loans in Florida that is a non-recourse loan. So when the loan becomes due, there's no one personally obligated. There's no deficiency if the value of the loan exceeds the value of the property.
No, there's not.
And what a lot of people say to me is, but wait, when mom dies, dad dies, we got to pay that loan back. Well, yeah. And if it's a regular mortgage, and mom and dad are using a regular mortgage, and mom and dad die, you're going to have to pay that mortgage back. So there's really no no difference there either.
Yeah, but you just refinance it or you sell it,
You know,
basically. What I tell
that
them.
brings up an interesting topic, and it's something that I think a lot of people a few years ago got misinformation on, and I doubt there's as many of them out there, but they tend to take a little longer to get through the foreclosure process if somebody has a reverse mortgage. But we would have people a few years ago that would inherit a property that would have a reverse mortgage on it, and they were discouraged, or maybe got bad advice about not looking at doing a short sale because they were concerned about their personal liability in that type of situation. So if there's someone out there with a reverse mortgage that they inherit the property, or they're they're involved in an estate, talk about that for just a second.
Yeah,
I think it's important.
The person who inherits the property, so mom and dad have a reverse mortgage and they pass away, and so the kids now inherit the property with a reverse mortgage on it. Well, they're not personally liable for that mortgage. And what I'm finding, I've actually got a couple of clients in this situation, what I'm finding is that the reverse mortgage companies are now saying, get the property appraised, give us 95% of that value,
And let's short sell
you
it.
can have the property, we can sell the property.
Oh, or you sell it directly, or they can buy it.
If the son, daughter, heir, whomever can raise 95% of the appraised value of the property,
then they can take it.
right, now that's obviously going to differ by mortgage company.
Sure.
But that's what I've got 2 deals with that same offer on the table right now.
So I think it's important for anyone out there that has a reverse mortgage or inherits one. Make sure to really, unfortunately, a few years ago, there were a lot of unscrupulous people. There were investors. There were people that were preying on people through short sales and giving bad advice. There were real estate agents acting as short sale gurus that really shouldn't have been doing it and giving people wrong advice.
The biggest one that we saw was someone who would otherwise qualify for a reverse mortgage who was upside down on their house, and a reverse mortgage, quote, specialist would come to them and say, hey, listen, why don't you get a reverse mortgage on your house and use that as a short refi of your existing loan. And a lot of the conventional lenders, the Chases, the Freddies, the Fannies, the FHAs, they weren't going for it. And so that's where a lot of that kind of fraud started to come in, and that's where I think a lot of the reverse mortgage industry got a bad reputation.
Yeah, there was definitely some stuff going on for a while that was really preying on people. It was kind of a challenge. So